Hello, Baker Investment students. Hope everybody had a good weekend. And as I mentioned, I'll post these like every Sunday in the morning to kind of get a preview of the week to come. So, good job with forum discussion last week. Everybody jumped in, contributed well, and just going to continue to do that. We'll see what happens this week. Last week, a little bit of craziness with the Iran crisis, and I saw that Iran, I believe, admitted that they did accidentally shoot down the Ukrainian jetliner. So that is good news for Boeing in that sense. I know they had a lot of problems in the 737, and we still ended the market on a fairly positive note last week. It was a little bit down on Friday, but we'll see what happens this week. That's one thing about markets, is that there can be events that can constantly impact the value of markets and what people perceive in the future. So this week, we're going to continue on with the same format. You're going to have a forum discussion, homework problems. We're going to look at just chapter 4 and 5 for the reading this week. So it's going to begin with the idea of return and risk. So you're going to look at historical returns. I put a website out there, MoneyChimp, and you can kind of go back and look at different periods of returns in the stock market. They have a thing called like a Kegelator that gives you an average rate of return. You figure for the U.S. stock market since existence, it's been about a 10% rate of return. So as long as you're in it for the long run, and as long as the foreseeable future continues to hold true based on the past, it's still one of the best rates of return on an investment for the risk that you're willing to take on. Again, if you have a short-term need, it's not the best, because one year, as we saw in the subprime crisis, people lost almost 40% of the value. But knowing that you're in it for the long run, for something especially like retirement, probably a good idea to have a majority of your monies and mutual funds invested in stocks for the long term. So with this concept of return, our textbook authors talk about the idea that it can be two parts. One is the interest or dividends that you receive from the asset, and the capital appreciation or loss. So hopefully it's a capital appreciation, but losses can occur too. So it's a combination of those two things that gives us the return. If we look specifically at a holding period return, it's what happened in that past year, that I had bought this particular mutual fund, or I bought this bond or a stock. What did I receive in return, either through investments, through interest or dividends, or a capital gain or loss? And you're going to go a little bit more detail with the idea of return, is that required rate of return is a combination of some real rate of return plus an inflation premium. I know in some of the forum posts, some of you all mentioned about the 10-year treasuries. You know, the yield is somewhere like 1.87%. But if you think about it realistically, the inflation rate, the Fed's hoping for it to be at least 2%. That's some of the things they mentioned this past week. And if it's greater than that, you're actually making a negative real rate of return. But most investors, you know, they're flocking to the treasuries for security, not necessarily for the rate of return. So, but as the risk increases on these investments, in addition to some real rate plus an inflation premium, we have an additional premium that we expect by taking risk beyond the risk-free rate. And generally, like a treasury security, treasury note, T-bill, bond, is considered to be the risk-free rate. In this chapter, you're going to go a little bit of review from like a corporate finance perspective. You've covered these things with internal rate of return. By definition, internal rate of return sets the net present value equal to zero. What it really means is I can look at a series of cash flows over a period of time, and I can see what that rate of return is, assuming that I'm reinvesting those interest payments or returns at that same interest rate. And the textbook also gives some examples in Excel where you can do the rate function to see what that rate of return was over a time period. And I would encourage you in the appendix, just kind of do that. I know that you've probably done these types of calculations before, but understanding the time value of money concepts, it's such a valuable tool. I would say especially for present value. What is something worth to us today is the premise of a lot of the analysis of what is something worth to us today, like an asset. Again, projecting out these future cash flows, if I discounted it back, what is that worth to me today? So excuse me, so spend a little bit of time in review on that. Last thing I'll just mention with that chapter 4, it talked about different types of risks, whether it's business risk, financial, purchasing power, interest rate, liquidity, tax, event, market risk. This kind of carries over to the other chapter, chapter 5. Essentially, by diversifying in other companies that are not correlated, we can wipe away a lot of that company specific risk, but we can never wipe away systemic risks, those risks associated with the market. And that's when we start getting the next chapter. You'll start to read things such as the standard deviation. Um, you'll look at correlation, uh, diversification. Correlation, essentially a number between -1 to +1. If it's +1, think of it, they both move in the same direction. If it's -1, they're moving in opposite directions. And if it's equal to 0, there's really no change. So sometimes you may actually see that in some of your portfolios, whether you have through Fidelity or the means or 401ks at work. They will have such things as like a portfolio beta. And to cover this concept of beta, I want you to think of beta this way. Think of the S&P 500 as the market, and say a company stock like Ford, which the returns can change, the dividends you receive, the price going up and down. But I want you to think of that, as the market fluctuates, like the independent variable, and what is Ford's returns. So if the market goes up 10% and Ford goes up 15%, well, that's like a portfolio beta 1.5. As another example, let's say that I pick IBM, and if the market goes up 10%, IBM goes up 10%, that'd be a portfolio beta 1. And if the market went down 10% and IBM went down 10%, that'd be still a portfolio beta, not portfolio, a beta of 1. And the chapter ties this into, and I think you've probably seen this before, the idea of the capital asset pricing model. This was developed by William Sharpe. He won a Nobel Prize in economics for this, which essentially says that the required rate of return on a stock is the risk-free rate plus beta times the difference between the market expected return and the risk-free rate. So obviously, as the higher the beta goes, the greater the expected rate of return. It doesn't mean that that return is guaranteed. It just says that the investor taking on that particular risk is expecting that rate of return. And according to the security market line, prices will adjust in the markets based on that risk and that expected return. To wrap some things up for this week, look at table 5.3. I think you'll find that interesting because that gives some examples. We look at that in the textbook in relationship to rates of return with a portfolio risk and portfolio return. It's trying to get you to recognize, by diversifying through different combinations of securities or investments, we want to try to eliminate that risk, because the larger the standard deviation, the greater the volatility. I want you to think of it that way. So they're trying to reduce the volatility by combining different types of stocks. And you'll actually see that with those, probably a William Sharpe model where he mentions that, where you actually kind of see, the textbook mentions that you start to add maybe about 40 stocks in portfolio. That can vary, but we can diversify a lot of that company-specific risk away. But we're always going to be exposed to the market risk. So if the market were to tumble, if we were to go to war with Iran and things get really bad, hopefully that will not happen, but that could be an event that could severely affect the global economy, and there's nothing you can diversify away about that. Probably the market's going to drop. But the other one, especially when you look at, was in figure 5.7, and this had to deal with the modern portfolio theory and diversification. But they come up with this page 192 where it shows the figure 5.7 about this idea of an efficient frontier. Reminds me of economics, like a production possibility frontier, but it basically says anything to the left is not really attainable, but anything on that line is obtainable, and to the right of that. But obviously we want to be on that line. But they give a set of indifference curves, and it says, hey, we want to be on the highest indifference curve, with the risk versus reward we're willing to take on. Essentially, that would be a 0.0. That would be the ideal combination of the portfolio that we want to choose. So we'll continue to do what you're doing. I hope to everything have great by Wednesday. But if you have any questions, do email me. I'll try to get back to you the following day at the latest. And if you have like a direct question, probably best to email me directly. I know in that kind of Ask the Professor, I don't check that as often. So if you want your answer answered more quickly, just make sure to do it through the email. Otherwise, have a great week and look forward to talking to you online.